you go back and listen to any of our podcasts that I did in 2017, 2018, 2019, every couple of episodes, I mentioned that I was very confident that there was going to be a significant opportunity in retail. Now, why is this? Well, the media hype around the retail apocalypse seemed to be peaking. There was some very significant businesses that were basically closing down and drastically reducing the number of stores that they had. I'm sure you're all familiar with the bankruptcies and the Toys R Us and the Sears and the like, big box retail centers that going to create a massive, massive headwind and likely some distress on that entire sector. Now, the claim that I kept making over and over again was, yes, there is massive headwinds. But number one, I have seen this story many times. When everyone is terrified of something, usually that terror seeps into sectors within the sector that it doesn't belong. And the point I kept making was, look, if you look at the rent roll and you don't see Sears and you don't see Toys R Us and you see things like Dollar Tree and mixed martial arts studios and pizza restaurants, they can act symbiotically and you're not getting that massive challenge that a lot of the big boxes are experiencing. And really the point I was making is that the media hype around the retail apocalypse was creating a massive pricing opportunity to purchase discounted assets in the retail space because the retail apocalypse was a bit overblown. So I wasn't just saying that. I was working a lot on that thesis. I was establishing relationships. I was underwriting deals. I was negotiating terms with different sponsors, trying to find a great opportunity for me and our investors to participate in. And I kept focusing on the rent roll. I kept focusing on who the rent roll was. Now, I actually ended up not finding a deal that made sense to me. Combination of price, combination of negotiations, combination of who the rent roll was and certain deals that were available to me. And I ended up not finding a deal through all that work I did through 2017, 2018, and 2019. So was I wrong? And what do I say in the wake of what's going on right now with COVID? So number one, I don't want to say that I was wrong. I feel like the thesis was correct, but did I get lucky that I didn't do a bunch of retail deals? Was it certainly luck that played a huge role in the fact that I didn't see the perfect deal? Because I was looking hard. I was dedicating a lot of my time to solving this problem. The problem being I wanted more exposure to the retail market. Now, the reason I say that it was luck is especially because of my focus on the rent roll. That turned out not to be the determining factor when it comes to COVID. There is plenty of examples of massive AAA credit tenants that are right now saying to their owners, the sponsors that I would trust, hey, guess what? We're not paying rent for 90 days and we'll call you in 3 months. And you can do whatever you want in the meantime and bill us and fine us or whatever, but we're not making it happen. That is something that I certainly did not predict when I was concentrating on the rent roll. And even the retail centers that are grocer anchored, which I also harped on really significantly, a lot of them have been hit as well. The grocery market, obviously considered an essential business, but the traffic drastically reduced otherwise and sometimes within the retail center. Because people, yes, are drawn to go pick up the groceries, but they typically spend time walking around otherwise. And that time walking around has been basically eliminated. And it's very, very, very difficult to predict on a sensitivity analysis that your gross sales of, let's say, the mixed martial arts studio are going to go down 100%. There isn't a sensitivity analysis that I've ever seen that assumes a 100% reduction in gross sales. So the real key takeaway here is if you listen to these podcasts I was doing and you were entering into the retail sector, at least educationally, with a skeptical eye, as you should always, the real key takeaway for me is you have to be prepared to be diversified. Because if I had gotten the perfect deals, yes, it would hurt, but it would not have put me or my investors in a position to destroy them financially because of the concept of diversification. And a lot of it is luck, but the luck is always a factor of any investment you make. That's just the reality of the situation. If you make 100 investments, they're all not going to be perfect, even if your thesis and partnerships and strategies and tactics are 100% perfect. So I want to talk briefly about some diversification limits that I like to play with. And these are always evolving as my knowledge as an investor evolves and my relationships evolve, as well as my strategy. I'll give you some reasons for that. So in terms of per sponsor allocation, my personal strategy right now, I feel comfortable somewhere in the range of 20 to 30% per sponsor. So if it's a perfect sponsor, really good brand alignment, really good investment thesis regarding the asset classes that I love, 30%. I think 40% to an asset class. And again, I should say up front, this is just my perspective, my personal strategy. This is definitely not guidance. Do not take this as financial advice. I would also say, because I have a lot of background investing in multi-property funds, I like to invest more significantly in funds as opposed to single asset entities, because you get the diversification inherent in a multi-property fund. So for example, I may feel uncomfortable with greater than 5% of my portfolio in a property, but I may be okay with 10% or 15% of my portfolio in a fund if they had, let's say, 2, 3, 4, 5, 10, or 20 properties. Now, the fund itself can be a fraud or something weird can happen, so I don't want to go too crazy with that concept, but I think somewhere in the range of 10% to a fund may be reasonable for me. Now, here's one of the reasons these numbers start to make sense. I am not one of the guys that wants to be diversified to the moon. I don't want to have 50 operators that I'm working with and getting 150K ones every single year. And there's two reasons for this. Number one, I want to go deep in terms of due diligence and focus, and I want to maximize the relationships that I have, because the relationships are hard to curate. When I go to invest with someone, I rarely invest with someone exclusively for my own personal portfolio. I almost always am investing with someone with the intention of working with them through ASIM Capital. And so part of my due diligence process, almost exclusively, is to invest with them first, prove not only proof of concept, but see what it's like to work with them, and then to bring our investors. Now, it's not 100% of the time, but it almost is. It's very close to that. So there's that component. The other component of this is that when I do due diligence, it's very thorough, as you probably can imagine. So the time commitment it takes to do due diligence necessitates that I must see a future with these principles and with this business model. Now, again, part of that's because I have knowledge about the world of passive investing, the likes of which not a ton of people have. Hopefully, I'm trying to get more and more people to have it with the show and everything. But I'm not the typical passive investor. And that needs to be the case. I have a reputation in the industry. So when I go to due diligence, if I just said, okay, send me the documents, send me the routing instructions, I'll send the money over, that's not a good look for me. So it necessitates that I do go deep on due diligence. So these things kind of line up, where if I want to only work with 10 operators for the rest of my life, I feel like that's perfectly reasonable. Now, it may be the case that I'm currently working with 5 or 10, but there's always going to be changes in the relationship. Their strategy may change. I may think that the industry that they're focusing on is getting too competitive, and I may take this switch. So I mentioned this before, but I probably have 6 operators right now that I would work really significantly with through ASIM Capital, and I'll probably spend the next 50 years figuring out the next 4 or 5 or 10. I think 10 is a good number, so 10 per operator may make sense, 10% per operator. So that's basically a quick summary of my plans for diversification, but I also wanted to circle back on the conversation regarding retail. If you go back and search Cashflow Connections retail, you're going to hear me have a lot of conversation with people I have a lot of respect for, and it seems like to a large degree we're able to overcome that by the combination of being very, very skeptical of the industry given the headwinds, a little bit of luck, and without that luck, diversification would likely have played a huge role in helping our portfolio continue to perform and the portfolio of our investors. So just a good lesson to learn. Want to be accountable about those claims. Hope that helps.
All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy. Leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asimcapital.com. That's ASYM capital.com. Thanks a lot.